If you strictly follow mainstream financial media, the narrative surrounding New York real estate appears cautiously optimistic. Headlines tout a return to office, a stabilization in rental prices, and the resilience of the Manhattan luxury market. Agents and brokers are aggressively pushing the idea that the worst is behind us, citing month-over-month data that suggests a soft landing. But if you peel back the layers of aggregated data and look at the structural mechanics of the market right now, a very different, far more alarming picture emerges. The market isn't stabilizing. It is fracturing. What we are witnessing in the current cycle is not a standard recovery, nor is it a standard crash. It is a bifurcated liquidity crisis. While ultra-prime assets continue to trade among the global elite, the vast middle of the market, the B-class office buildings, the rent-stabilized multifamily units, and the entry-level condos, is freezing over. The transaction volume has collapsed, not because there are no buyers, but because the bid-ask spread has widened to a chasm that financing cannot bridge. Sellers are holding on to valuations from the previous cycle, while buyers are underwriting deals based on a new reality of higher rates and regulatory risk. This shift is happening fast, and it is driven by forces that are largely invisible to the average observer. It isn't just about interest rates. It is about a fundamental repricing of the city's future viability as an investment vehicle. If you own property in New York, or are considering allocating capital here, you need to understand the hidden risks that are currently eroding the foundation of the market. But the most dangerous threat to New York real estate isn't coming from Wall Street or Washington. It is coming from Albany. In the second half of this report, we will reveal a specific piece of legislation known as good cause eviction, and how it is quietly destroying the net operating income of thousands of small landlords, turning profitable buildings into zombie assets. The commercial contagion. To understand the shift in residential real estate, we must first look at the commercial contagion. For decades, the value of New York residential property was implicitly backed by the strength of its commercial sector. Office workers needed apartments. Retail needed foot traffic. It was a symbiotic ecosystem. But today, that ecosystem is broken. We are seeing office vacancy rates in Manhattan hovering near historic highs. While Class A trophy buildings are filling up, the older vintage office stock is empty. This matters to residential owners because these empty buildings devastate the tax base. Commercial property taxes fund a massive portion of the city's budget. As commercial valuations plummet, some buildings are selling for 50% less than they did 5 years ago. The city faces a massive revenue shortfall. Who picks up the tab? You do. The shift we are seeing is a transfer of the tax burden from the commercial sector to the residential sector. We are already seeing proposals and early indicators of aggressive property tax hikes for residential owners to plug the budget gap. This tax shift directly erodes the affordability of owning a home in the city and suppresses future appreciation. If your property taxes rise by 20% while your property value stays flat, your real return on investment turns negative. Now that you understand how the commercial collapse threatens residential tax bills, you must see how the city's financial health impacts its ability to function. The next shift isn't just financial, it's operational. We are seeing a service-level decline that is driving families out of the city faster than high rents ever could. The fiscal cliff. New York City is currently staring down a fiscal cliff of unprecedented proportions. The federal pandemic aid that propped up the city budget has expired. At the same time, the costs of managing the migrant crisis and servicing municipal debt have exploded. This creates a structural deficit that cannot be solved with minor cuts. This fiscal reality is shifting the psychology of the buyer. In previous cycles, buyers accepted high taxes in exchange for world-class services, safe subways, clean streets, and good schools. But in the current market, that social contract is fraying. We are seeing a deterioration in public services precisely when the cost of living is rising. This divergence, paying more for less, is triggering a quality-of-life exodus. It isn't just the ultra-wealthy leaving for Florida. It's the upper middle class, the families who form the bedrock of the housing market. They are moving to the suburbs or out of state, taking their tax revenue and their housing demand with them. This demographic shift is creating a ceiling on prices in family-sized apartments in neighborhoods that used to be fiercely competitive. However, while the city struggles with its budget, landlords are facing a direct assault on their ability to generate revenue. The next shift we need to discuss is regulatory strangulation. New laws are making it mathematically impossible for owners of rent-stabilized buildings to maintain their properties, leading to a wave of distressed sales. If the fiscal cliff is a macroeconomic threat, the next shift is a microeconomic disaster for property owners. We are moving from the abstract concept of city budgets to the concrete reality of your monthly profit and loss statement. For generations, multifamily real estate in New York was considered the bond market of real estate. Safe, steady, and predictable. But recent legislative changes have turned that safety into a liability. The shift here is from asset ownership to asset stewardship without control. The regulatory strangulation. The passing of good cause eviction and the tightening of rent stabilization laws have fundamentally altered the math of owning rental property in New York. On the surface, these laws are designed to protect tenants. But the unintended economic consequence is the destruction of net operating income, NOI. Under the current regulatory regime, landlords are severely limited in how much they can raise rents, even when a unit becomes vacant. At the same time, their operating costs, insurance, water, taxes, and heating oil, are rising at double or triple the rate of inflation. This creates a negative leverage scenario. The cost to run the building is increasing faster than the revenue the building generates. We are seeing a wave of distressed listings in the multifamily sector, not because the buildings are empty, but because they are structurally unprofitable. Long-time owners, who held these properties for decades, are capitulating. They are selling at significant discounts because they cannot legally raise rents enough to cover the necessary capital improvements. This matters to you even if you don't own a rental building. When landlords cannot profit, they stop maintaining the buildings. This leads to a degradation of the housing stock. We are beginning to see zombie buildings, occupied structures that are falling into disrepair because the owner has no capital to fix the boiler or the roof. But if you think the regulatory squeeze is the only thing hurting property values, wait until you see what the banks are doing. While Albany restricts revenue, Wall Street is restricting capital. We are currently in a refinancing crisis that is trapping thousands of owners in loans they can no longer afford. The financing freeze. For the past decade, New York real estate was fueled by cheap, accessible debt. Regional banks were eager to lend on almost any asset. But in the current cycle, that liquidity tap has been turned off. Following the collapse of several key regional banks that specialized in real estate, the lending environment has tightened dramatically. We are seeing a credit crunch, specifically targeting New York assets. Lenders are looking at the regulatory risks we just discussed, rent caps and eviction difficulties, and deciding that New York real estate is high risk. As a result, they are demanding higher interest rates, lower loan-to-value, LTV ratios, and larger debt service coverage reserves. This is creating a crisis for owners who need to refinance. A borrower who took out a loan 5 years ago at 3.5% is now facing a refinance rate of 7% or higher. For many properties, the new mortgage payment consumes the entire cash flow. Owners are being forced to bring cash in to refinance, writing a check for $500,000 or $1 million just to keep the building. Most owners don't have that liquidity. This forces them to sell into a weak market. We are seeing transaction volume in the investment sales market plummet by 50% or more in some boroughs. This lack of liquidity makes it impossible to establish true market value, creating a shadow correction where prices are likely much lower than the data suggests, simply because no one is trading. Now that you understand how financing and regulation are squeezing landlords, you must see how this impacts the buyer at the individual level. The next shift is hitting the co-op and condo market directly. We are seeing a maintenance fee explosion that is making even affordable apartments impossible to hold. If the financing freeze is a crisis for landlords, the next shift is a direct assault on the monthly budget of every condo and co-op owner in the city. We are witnessing a decoupling of purchase price and carrying cost. Historically, if you paid off your mortgage, your housing costs were minimal. But in the current New York market, the monthly maintenance fees and common charges are rising so fast that they are becoming a second mortgage that never goes away. The maintenance fee explosion. Across the city, co-op boards and condo associations are issuing double-digit percentage increases in monthly fees. This isn't just standard inflation, it is a structural reset of operating costs. Insurance premiums for multifamily buildings have skyrocketed. The cost of labor for doormen and porters has increased due to new union contracts. And perhaps most significantly, the cost of compliance with Local Law 97, the city's aggressive green energy mandate, is forcing buildings to spend millions on retrofitting boilers and windows. Who pays for this? You do. We are seeing affordability shock among buyers. A buyer might be able to afford the $800,000 purchase price, but they cannot qualify for the loan because the monthly maintenance is $2,500 and rising. This suppresses the resale value of the apartment. For every dollar the maintenance fee goes up, the value of the unit goes down, because the buyer's monthly payment capacity is fixed. This shift is creating a trap for long-time owners. They want to sell and retire, but the high maintenance fees on their older units make them unattractive to younger buyers. We are seeing listings linger on the market for months, forcing sellers to offer maintenance credits, essentially paying the buyer's fees for a year or two, just to close the deal. But while the middle of the market struggles with fees, the top of the market is dealing with a different kind of excess. The luxury inventory glut is real, and it is exposing the myth that New York real estate is always a safe haven for global capital. The smart money isn't buying, it's waiting. The luxury inventory glut. For years, developers built thousands of super luxury condos, banking on an endless stream of foreign oligarchs and tech billionaires to buy them. They built for a buyer who doesn't live here. But in the current geopolitical and economic climate, that buyer has disappeared. We are seeing a massive accumulation of unsold inventory in the $5 million to $20 million range. These ghost towers are sitting half empty. Developers are quietly offering massive concessions, covering closing costs, paying mansion taxes, and even discounting the purchase price by 20% or more behind closed doors. This shadow inventory hangs over the market. It prevents price appreciation because there is always a brand new, empty unit available down the street. It also creates risk for the buildings themselves. If a building is only 50% sold, the remaining owners have to shoulder the burden of the common charges if the developer defaults. We are seeing high-end buildings enter financial distress, something that was unthinkable in the previous cycle. The shift here is from scarcity to abundance. The exclusivity premium of New York luxury real estate is eroding because there is simply too much of it. Now that you understand the inventory issues at the top, you must see the final, most culturally significant shift. The neighborhood rotation is changing where value lives in the city. The old blue-chip neighborhoods are stagnating, while capital flows to new, unexpected areas. The final shift we are witnessing is perhaps the most profound because it challenges the very geography of wealth in New York. For a century, the rule was simple: Manhattan is king. The closer you are to Midtown, the more valuable the dirt. But in the current cycle, that gravity is reversing. We are seeing a neighborhood rotation, where value is draining from the center and flowing to the periphery. The geographic re-rating. The rise of hybrid work has fundamentally altered the commute calculus. Buyers no longer need to pay a premium to live 15 minutes from Times Square if they only go to the office 3 days a week. They are trading proximity for space, greenery, and community. We are seeing stagnation in traditional blue-chip neighborhoods like the Upper East Side and Midtown East. Prices there are flat or falling in real terms. Meanwhile, neighborhoods in Brooklyn and Queens, areas that were once considered secondary markets, are seeing record pricing. Brownstone Brooklyn has effectively decoupled from the rest of the city, trading at a premium that rivals Tribeca. This isn't just about gentrification, it is about lifestyle liquidity. Buyers are voting with their wallets for neighborhoods that function as self-contained villages with good schools, parks, and dining, rather than neighborhoods that function as dormitories for office workers. The Manhattan premium is evaporating because the utility of living in Manhattan has diminished. My final verdict: navigating the fracture. So, what does this fractured landscape mean for you? New York is no longer one market. It is a collection of microclimates, some of which are thriving while others are entering a deep freeze. For buyers, this is a moment of extreme caution but strategic opportunity. The headline price is often a lie. You must look at the all-in monthly cost, including the rapidly rising maintenance fees. Do not stretch your budget to buy a deal in a building with weak financials. A special assessment could bankrupt you. Look for motivated sellers in the stagnating blue-chip neighborhoods who haven't adjusted to the new reality. There is value in the uncool neighborhoods if you have a long-term horizon. For sellers, the days of aspirational pricing are over. If your property has a flaw, it needs renovation, it has high maintenance, or it's in a less desirable building, the market will punish you severely. You must price aggressively to find liquidity. If you are sitting on a generic condo in a saturated neighborhood, competition is your enemy. You need to offer concessions or staging to stand out. For investors, the multifamily sector is currently a falling knife. Unless you have deep pockets and the operational expertise to navigate the regulatory minefield, steer clear of rent-stabilized assets. The risk-adjusted return simply isn't there compared to risk-free treasuries. However, the free market rental sector in the outer boroughs remains robust due to the chronic housing shortage. The New York market is shifting fast. The old rules of location, location, location are being rewritten to liquidity, solvency, and lifestyle. The city isn't dying, but it is undergoing a painful, necessary evolution. Those who understand the new mechanics will find pockets of immense value. Those who rely on the old narrative will be left holding the bag. If you found this deep dive valuable and want to see the specific data on which neighborhoods are seeing the highest price cuts right now, make sure you are subscribed.